A neon landscape that used to feel permanent is flickering in real time, and analysts say 2025 may be the year several household name restaurants finally go dark. Store counts are shrinking, bond payments are wobbling, landlords are filing eviction suits, and consumer tastes are shifting faster than legacy menus can pivot. 7 brands, each once touted as bulletproof by investors, now share one uncomfortable metric. Locations are closing at a pace that outstrips openings by triple digits. Regulatory filings, franchise owner interviews, and credit rating agency memos paint the picture of a tight labor market, inflation-warped food costs, and a customer base that demands better ingredients, faster service, and a cleaner digital experience than many pre-smartphone-era chains were built to deliver. Behind every darkened drive-through lane lies a checklist of missteps: crushed unit economics, burdensome supplier contracts, private equity leverage, or simply a concept that aged out of relevance. The data suggests that without dramatic reinvention, these banners could be historical footnotes before the next presidential race is decided. Subway is the global case study in overextension turned retrenchment. A decade ago, its 41,600 outlets formed the biggest restaurant fleet on the planet. Since 2018, the chain has surrendered more than 4,000 domestic storefronts and quietly transferred hundreds of international licenses to local conglomerates that can stomach narrower margins. Franchisees pay royalties and national advertising, levies that exceed 12% of sales, double what many emerging fast casual brands collect. Operators complain that weekly produce deliveries spoil on slower foot traffic days. If they scale back inventory, mystery shop audits threaten their contract standing. Menu credibility also took blows. Public pressure forced the company to remove azotic carbonamide from bread dough after food activists noted the additive's industrial uses. A 2021 DNA study commissioned by plaintiffs in a California suit alleged mislabeling in the tuna blend, prompting social media memes and an expensive legal defense, even though the action was later trimmed. System-wide sales per unit hover around $420,000, barely half-peak levels, while rivals Jersey Mike's and Firehouse Post averages above $900,000. Subway's parent family hired J.P. Morgan to explore a sale at a suggested $10 billion valuation, but bankers acknowledge any buyer must fund a capital-intensive remodel program and renegotiate thousands of leases that were signed when commercial rents were cheaper and customer counts higher. Boston market is fighting a narrower yet steeper descent. After topping 1-800 restaurants in the late 1990s, the brand now lists fewer than 280 active units, and that figure is fluid. State labor departments in New Jersey, Massachusetts, and Colorado have issued stop work orders for unpaid wages, while Cisco and other broadline distributors filed suits over delinquent invoices. In August 2023, the chain's Golden, Colorado headquarters was padlocked over $327,000 in missed rent, forcing executives to run operations from remote laptops as the main phone line went unanswered. Analysts point to the brand's failure to diversify beyond heavy comfort food plates at a time when grocery stores upgraded rotisserie programs and quick-service competitors rolled out lighter bowls and salads. Internal documents leaked by a former district manager showed dinner-hour transactions down 48% year-over-year in markets where supermarket hot bars expanded. With no cash to refurbish aging equipment, rotisserie motors average 23 years old. Some stores resort to partial menus or shutter days at a time, accelerating the traffic spiral. Steak and Shake, once a Route 66 staple, prized for tableside service on a fast food ticket, also confronts a structural mismatch. Labor Bureau statistics reveal that a full-service concept charging $5.99 for a double steak burger plate cannot cover wage inflation that lifted average crew pay 28% from 2019 to 2024. Parent Biglari Holdings attempted conversion to counter service. Kiosks cutting 3 front-of-house positions per shift, but customer counts kept sliding. Wait times, still near 25 minutes from order to food, clash with the sub-5-minute expectations set by McDonald's and Five Guys. SEC 10K filings show that between 2018 and 2023, unit count plunged from 626 to 262. Same-store traffic fell another 9% last fiscal year, even after price hikes. Credit Sites estimates total debt at $282 million against EBITDA of $34 million, a ratio that would breach covenants if comps dip single digits again. Checkers and Rally's, the 2 named double drive-through curiosity, had once predicted its small footprint boxes would flourish in a takeout future. What the model did not factor was CapEx drag from retrofits, adding third-party delivery lanes, audio AI ordering, and kitchen printers in buildings originally wired for 1990s headsets. Oak Hill Capital's 2016 leveraged buyout loaded $300 million notes onto the balance sheet. By 2023, the company cited $650 million in liabilities when it filed Chapter 11. Lenders granted a restructuring deadline, but required the sale of 87 corporate stores to franchisees, some of whom balked when inspections revealed HVAC and fry line deficiencies. Meanwhile, average unit volumes stagnated near $1 million, stuck between Wendy's $1.9 million and regional Darling Cookouts $1.6 million, while food costs for beef and frying oil rose 21% in 2 years. The much-promoted fry. Lover's Burger could not lift check size enough to compensate. Del Taco, now owned by Jack in the Box, illustrates the hazards of middle-tier positioning. Its 580 store count has inched backward as the parent rationalizes overlapping territories. Sales cannibalization occurs where Del Taco's value tacos compete with Jack's late-night dollar menu, yet remodeling budgets prioritize the primary brand. Consumers chasing freshness lean toward Chipotle or local taquerias. Bargain seekers default to Taco Bell. Same-store sales grew a bare 1.1% in 2023, trailing food away from home inflation by 4 points, meaning real volume slide. A 900-square-foot prototype announced in 2022 produced encouraging car counts, but franchising interest cooled when construction bids ballooned 35% due to concrete and HVAC cost spikes. Crystal, the Depression-era slider institution, emerged. From its 2020 bankruptcy with 300 stores, $27 million of new equity, and a mandate to modernize. COVID-era dining room closures played to its drive-through strength, yet the brand never recaptured pre-file volumes. An audit by restructuring advisor Duff & Phelps found 42% of buildings required roof or plumbing overhaul, exceeding $250,000 each. Capital the post-bankruptcy owner has been slow to deploy. Consumer surveys show younger diners perceive the brand as dated. A limited test of alcoholic slushies and celebrity side chick sandwiches posted double-digit lifts in test cities, but supply chain constraints throttled rollout. Industry trackers now count roughly 275 open crystals, and local press in Alabama and Georgia report lease defaults still surfacing. Quiznos provides the cautionary tale in franchise or franchisor misalignment. Rewind to 2007, 5,000 shops, lines stretching for toasted mesquite chicken. But contracts forced owners to purchase food only through corporate distribution at 30 to 40% premiums. Franchise disclosure documents show food cost ratios that routinely exceeded 38% of sales, 8 points above category norms, rendering profitability elusive. Lawsuits mounted. By 2014, the chain entered its first bankruptcy, then a second in 2018 that swapped debt for equity but left fewer than 300 domestic stores. A Denver tech fund acquired the intellectual property in 2021, plotting a Quiznos 2.0 focused on ghost kitchens and tiny walk-up units. 2 years later, only a dozen prototypes operate. Market research firm Technomic's 2024 census lists 168 U.S. Quiznos, a 96% collapse from peak, and supply contracts for Signature Bread expired last spring without renewal, forcing independents to source substitutes. Industry veterans draw parallels among the 7: out-of-date decor, lagging app development, franchise discontent, and menus insufficiently agile to absorb commodity spikes or shifting dietary preferences. Each faces stiffer competition from regional upstarts that open with lower leverage and social media buzz instead of 40-year-old jingles. Bankers whisper that private equity maturity walls in 2025 will drive consolidation or liquidation. If that unfolds, American roadside culture could lose a patchwork of familiar neon before the next family vacation season even begins.